Close to 1,200 American and African business leaders are currently meeting in Addis Ababa, Ethiopia, to discuss ways of boosting trade and investment between the regions. Direct flights between the U.S. and African countries, as well as trade pacts like AGOA, have the potential to push trade further than ever. But analysts say Africans need to be better poised for the challenge and deals with its investors more fairly negotiated.
When Kenya's transport minister announced that the country will start direct flights to the United States this year, one analyst called it a silver bullet for East Africa's biggest economy. It took years for Kenya to qualify. Only 4 other African countries, South Africa, Cape Verde, Ethiopia and Nigeria, score a minimum of 80 required by American aviation authorities for direct commercial flights to the U.S. Within the African Growth and Opportunity Act, the flagship of U.S. trade policy in Africa, the potential for business could be even higher thanks to these flights.
Now it means when you talk about AGOA and you talk about Kenyan traders, they have an opportunity to directly move to the U.S. and transact and come back. When you talk about U.S. investors, the same thing. Because remember, we are in 2 different time zones. And sometimes the time zones might discourage a potential investor, looking at the time to travel. There's so many connections. Now, if you offer them a chance that, there's a direct flight, it makes it easier for them then to make decisions. So it's a significant point.
The African Growth and Opportunity Act, AGOA, allows nearly 40 countries in sub-Saharan Africa to export some goods free of duties and quotas to the U.S. With oil accounting for most $26.8 billion worth of exports from Africa in 2013, and U.S. demand for petroleum product falling due to its own rising supplies of shale gas, some African economies have struggled to diversify their offerings. The trade program has also been criticized for disproportionately benefiting certain industries like oil and a handful of countries including Nigeria, South Africa and Angola. The pact is accused of imbalances as the U.S. only grants access to exports that do not affect local markets, while African nations have less say.
The issue of sovereignty has been raised. It also increases the level of dependency, and that dependency may not be very good for the country in the long run. In the short run, of course, some people may feel good, but it's a debate issue. Did we do the right thing in that regard, especially when it is not reciprocal?
Rodolfo Singa, an administrator at one of the export processing zones that churn out finished garments for companies like Old Navy, Victoria's Secret and Tesco, says suspension of one African player spells opportunity for another.
I remember what happened in Madagascar when they were banned in AGOA. Most of investors now ran away. They came to Kenya, some went to Ethiopia, and that was the thing. So once he put some stringent measures on South Africa, you'll feel most of investors now will have to look for a place where the country complies, like in Kenya or another country like Uganda or in other countries. So that's how it happens.
Even as an economic slowdown in China affects many of Africa's commodity-driven economies, the East still poses a counterbalance to Western influence on the continent that has prompted growing calls from policymakers and economists for more balanced trade relations. African countries have also been challenged to further explore the potential of their own influence and the possibilities of trading more with each other.
And Royal Dutch Shell PLC, which is on the brink of completing the oil industry's largest deal in a decade, said fourth quarter profit fell 44% after the rout in crude prices deepened. The company said in a statement that profits adjusted for one-time items and inventory changes shrank to $1.8 billion, near the midpoint of the preliminary $1.6 billion to $1.9 billion range it gave last month. Crude's collapse has slashed earnings for oil companies from ExxonMobil, to BP, leaving them struggling to strike a balance between investing for growth and making shareholder payouts. Shell is betting its $50 billion acquisition of BG Group PLC will help it maintain dividends and increase oil and gas production at the time when cash flow is shrinking. The company has, however, confirmed it is cutting 10,000 jobs amid its steepest fall in annual profits for 13 years. The World Economic Forum may have come and gone, but the takeaway for the African countries, especially as most African countries face strong economic headwinds, remains the key issue. Elsie Kanza is the head of Africa and member of the Executive Committee of the World Economic Forum. She spoke to a correspondent, Harriet Agbeyi, on the sideline of the forum in Davos, in Switzerland.
There's a very strong affirmation that we need to strengthen resilience, right? We need to put in place buffers. So that's a major takeaway. And in this, Africa is not alone. And therefore, there are many people putting their heads together to say, hey, what do we do to ensure that we continue to sustain prudent macroeconomic policies and frameworks? How do we address the debt burden that's re-emerging because of the currency devaluations? And more importantly is how do we continue to invest, particularly with these new commitments to the Sustainable Development Goals, as well as the climate change COP21.
Another issue that kept coming up was, collaboration between the public-private sector. Do you think that African governments are actually leveraging on collaborations with private sector?
Absolutely. And in Africa, we have a strong track record with an agriculture initiative, a Grow Africa initiative, which is a major flagship for such kinds of collaboration. And in Africa, we have 12 countries that are participating in this new approach to accelerating investment in agriculture. And I'm happy to say that Nigeria, again, is one of them. And we're already seeing the impact that it's having on improving the lives of smallholder farmers, increasing their incomes, and increasing the production of agriculture. But besides agriculture, we have collaborations in the form of projects and initiatives related to infrastructure, related to health, related to skills, related to the environment, related to trade, related to ICT. I mean, these are things that are happening in different countries across the continent throughout the year, and even here in Davos.
Let's talk a little bit more about the SDGs. There are about 17 of them. Now, from conversations heard yesterday, it's an ambitious one, and a lot of the participants feel that it shouldn't always be left for the public sector alone. I guess that's the reason why maybe there wasn't a full accomplishment with the 8-point agenda of the Millennium Development Goals. So how do you think African governments can achieve, even if it's not the whole 17, but at least achieve a sizable number of those goals? Now, let's talk a little bit more about participation here. It's been said that African delegates were kind of scarce at this particular meeting.
Well, actually, that's not true. Okay. Not at all. We have at least 100 Africans participating, and they're representing at least 17 countries. We had heads of state and government present, from the President of South Africa, the President of Rwanda, Prime Minister of Ethiopia, Prime Minister of Cote d'Ivoire, the Vice President of Nigeria, President of Guinea, and we're actually expecting the President of Gabon to be joining us today. So you can see it's quite a large group, and is totally in line with the participation over the last few years. One key step change for the SDGs compared to the MDGs is that they're not just focused on developing countries, but they're actually global in nature, which means that they touch upon almost every facet of our lives. In this regard, the ambition in terms of needs far outstrips what governments can do. Whereas with the Millennium Development Goals, there was a lot of emphasis on aid. With the changes in the global economy, we can clearly see that aid is dwindling. The past commitments have not yet been met. And therefore, if we remain committed to eliminating poverty, for instance, to addressing issues related to inclusivity, and this includes gender parity, we cannot afford to wait for the government to have enough resources to address those needs. One misconception that you hear quite often is that, well, isn't it sufficient for business to pay taxes? and then governments can decide how to allocate their resources.
Okay, so we'll keep our eye on that and hope that more private organizations will buy into this idea that you've just shared and what most of the other participants have also been talking about here at the forum. But thank you so much, Elsie, for speaking with us.